Hello again, welcome back to the channel. This is now a chapter or a longer chapter on personal tax liability and the possibilities of tax saving in that context. Well, the first thing is reasons why personal tax liability and tax planning can have to do something with each other. We are here at the moment, so third chapter. After now the measures where we can influence the tax base, now we think about the rules how we can tax the tax base, so personal tax liability. Let's first begin with reminding you of an important fact or theorem. As you perhaps remember, tax planning always happens when identical things are treated by different rules. So when you have different rules, so two people have, let's say, 100,000, and they could either lead to a tax of 50,000 or to a tax of 30,000, then it's clear that everybody wants to get these rules applied, which only lead to the tax of 30,000. So different rules for comparable situations always lead to the wish to choose, so to tax planning. Now, the two types of personal tax liability, limited and unlimited tax liability, also show a vast set of differences. So they invite us to think about which tax liability is the better one for us. So let's begin with the income which is covered. In the first case, unlimited tax liability, that's worldwide income. In the other case, it's limited only to the inland income. So differences may play a role if we have a worldwide income which deviates from the inland income. It makes no difference at all if the worldwide income and the inland income is the same because we have no income from abroad. Then differences may also lie in losses from abroad. If we have an unlimited tax liability, losses from abroad might qualify as a part of our worldwide income. Profits and surpluses from abroad too, but that now depends on what we have. If we have profits from abroad, we would like to get them ignored. And if we have losses from abroad, we would like to get them included into our taxable income in the inland. So the situation is different. The types of income which are covered under the unlimited tax liability, all the 7 types of income are comprehensively covered. Under limited tax liability, they are only covered as far as they are listed in paragraph 49 ESDG, and 49 does not list all the activities which are included under the 7 types of income in paragraph 2. Differences might be, for example, inland business income is only taxable under limited tax liability if you have a permanent establishment here. Simple interest income from the inland is not taxable at all under limited tax liability. So you would prefer to be taxed under limited tax liability if you live from interest from a bank account, naturally, because that's not included in the limited tax liability list. In the other one, it is. The tax rates. Under unlimited tax liability, the tax rate is progressive, and it's determined with a look to your whole worldwide income. So the rate is rather high. Under limited tax liability, it's rather clumsily determined. The withholding tax rates are mostly definitive, and what is taxed under a withholding tax is usually not counted for the determination of the tax rate for the rest of your income. Then only your inland income counts. So if you live from dividends, license fees, supervisory board membership fees, and rental income from the inland, then only the rental income amounts will determine your progression for your taxable income here. All the rest is done by withholding tax rates, which can be relatively moderate. 15% on a license fee instead of 45% of the profit is relatively advantageous if you have a low amount of business expenses. Progression only on a very small part of your inland income is far more attractive than the progression determined with an eye to your complete worldwide income. So these differences play a role. Unlimited tax liability: if you have things which are not a part of your taxable income, then the proviso safeguarding progression takes place and ensures that your progression nevertheless corresponds to your real wealth in that year. If you are a limited tax liability taxpayer, the proviso rules are usually not applied, and so your real wealth does not influence your progressive rate in the inland. On the other hand, if your foreign income is negative, it might push down your progressive rate, then you would regret being not unlimited tax liable. So personal allowances for insurance company contributions, for old age contributions, and all that. You can deduct them under unlimited tax liability, but you can't deduct them under limited tax liability, at least in most cases. So here the advantage would lie with unlimited tax liability. The same with children's allowances and similar stuff. So all the personal allowances, special personal allowances, special expenses, as they are literally called in German law, all that is in favor of unlimited tax liability. There, this is more advantageous. Limited tax liability there is rather behind. Let's call it a bit behind. The splitting procedure, so joint assessment of married couples where the progression is leveled. You get it if both spouses are unlimited tax liability taxpayers and live in the inland mostly. You don't get it if you are a limited tax liability taxpayer. So you have many differences between the two personal tax liabilities, which strongly might influence your tax burden. So imagine you have 10 children, are married, and have been divorced 3 times. Then you have a vast amount of potential personal tax allowances. And so you would be strongly interested in the possibility to be able to deduct them here. So you would prefer unlimited tax liability. Now, if you earned an income of 100 million from license fee, probably you would not bother about the privilege to offset your children's allowances from the tax base. You would regard it far more attractive to exchange a 45% tax rate on the profit against a 15% tax rate on the revenue. So to switch over to limited tax liability. So depending on your personal situation, you would rather think the one or other kind of personal tax liability more attractive. And that's clear. That gives you a strong incentive to think about your personal situation and to change it in order to influence your tax burden accordingly. So to switch between the different personal tax liabilities. Some advantages are with the one kind and some with the other kind. So there is no general rule that one kind of tax liability is better than the others. Each has its advantages and disadvantages. So you will analyze your personal situation and decide what's better for you. Nevertheless, it cannot surprise us that some people who are unlimited taxpayers want to become limited taxpayers. Imagine the guy with the license fees, 1 million. You exchange 45% on the profit against 15% on the revenue as a withholding tax, which is definitive. That's a great deal. You would like that. Some other people are limited tax liability payers, but they would strongly desire to become unlimited tax liability taxpayers instead. For example, a low income but several children, married, and huge contributions for Social Security, which they would like to set off from the tax base. So they would prefer strongly to become unlimited tax liability taxpayers. So the whole thing makes a huge difference, and you might say, well, but if you exchange the worldwide income against the inland income or the other way around, for example, if you are a limited tax liability payer, you don't want to change over to unlimited tax liability because then the worldwide income becomes taxable. But, ladies and gentlemen, in most cases, your inland income is your worldwide income. And in most of the remaining cases, most parts of your income from abroad are tax-free under the exemption method in the inland under a double taxation treaty. So the question how much is taxed usually does not make a great difference. Mostly only your inland income remains really liable to tax in both cases, but the rules how it is taxed are completely different. And that now explains why people are especially keen on exchanging the rules for personal tax liability, the worse one against the better one. And that makes choosing the best kind of personal tax liability even more attractive. So one can really expect in reality that people try to manipulate or better to change their personal tax liability to that kind of tax liability which pleases them most, which leads to less the lowest taxes in the inland. Now the question is if the legislator likes that or not, and now the answer is different. In some situations, the tax legislator regards it as okay, excusable, adequate, or even desirable if somebody who is a limited tax liability taxpayer crosses over to unlimited tax liability. There might be cases where limited tax liability is regarded as illegitimate or as a source of probably unfair tax advantages, and so is fought against with special countermeasures. Also, becoming a limited tax liability payer, not also, but in certain situations, limited tax liability might be regarded as a kind of artificial behavior just because of the tax difference. And the strange consequence in Germany has been we do not remove the differences between unlimited and limited tax liability, which cause that problem, but they introduced a special countermeasure legislation for people who are suspected of having become limited taxpayers only because of tax reasons. So it doesn't seem to bother people that there are differences which are unfair, but it seems only to bother people that there are clever people who make use of that difference and then try to get the more advantageous treatment for themselves. So for these cases, there has been created a special extended limited tax liability, paragraph 2 ASTG, which is aiming at those people who lived in Germany and are suspected of having left the country only in order to improve their tax status. In other cases, it has been regarded as rather legitimate if somebody wanted to obtain the status of an unlimited tax liability taxpayer in order to be able to offset personal allowances if that was not possible in any other state. So under that perspective, the legislator even created an option for people from abroad to opt for unlimited tax liability rules if they fulfill certain conditions. Well, then there is still a third kind of personal tax liability of special kind, an extended unlimited tax liability, which combines granting certain people some privileges of unlimited tax liability, for example, the personal allowances, but on the other hand, securing that these people which are covered by that special rule do not escape the taxation of the worldwide income in all the states of the earth together. So rather complicated. So the conclusion is, in the field of personal tax liability, we not only have the two basic types, at least in German law, of unlimited tax liability and limited one, but we have also intermediate forms which have developed over time. That is, first, that extended limited tax liability, who is meant for deterring people from leaving the country only because they want to become taxed with their German income as limited taxpayers. Then there is that extended unlimited tax liability in paragraph 1.2 ESDG. By the way, that's mostly covering diplomats and comparable people living abroad. And then there is what I already mentioned, an option for limited taxpayers who fulfill certain conditions, an optional unlimited tax liability in paragraph 1.3 ESDG, and that also has a more convincing extended form where also the possibility exists to apply for joint assessment as a married couple, although you live abroad. So rather a few variants, and that is why we have to deal with these different forms now in order to repeat them and to understand a bit what can be done with them, when they can be applied, and why their existence is motivated. So that's it, what we have to know. An additional remark may be permitted. Juridical persons up to now basically only know these two basic forms, the unlimited and the limited tax liability, because there the difference is progression does not exist, personal allowances does not exist. So most of the differences which could motivate people to switch between the two kinds of personal tax liability do not exist in the field of corporate taxation, so that up to now no need to create intermediate forms to fight tax saving model or to bring tax saving wishes into moderate and agreeable form. All that has not happened in the field of corporate taxation. This may be sufficient as an introduction, and after the last videos, which were rather long, this one is going to be a very short one, so this is only this introduction, and more details come in the next video. Thanks for watching this small little video, and hope to see you again soon on this channel. Thanks and goodbye.